This is the One Point Podcast, and I'm Rohit Yadav. Today, we are covering the topic of investing into private markets from a secondaries perspective, and that specifically in the venture segment. And to do this, I have Sim Desai joining me today. Sim, thank you so much for taking the time.
Rohit, thank you. It's great to be here.
Sim is the founder of and CEO of Hiive, an extremely popular VC secondary platform founded in the US. Hiive recently released their 2025 annual State of Private Market report, which is very insightful and a must read for everybody. So let's dive in. Sim, can you introduce Hiive to the audience?
Sure. So Hive is a liquidity management platform for private companies and their shareholders. So our main stakeholder and customer is the private companies themselves who want to offer liquidity to their shareholders and in an automated and centralized environment with the appropriate controls in place and a secure process and a regulated process. So that's why we created the technology of Hive. Of course, as a result, we therefore are a place where investors in private securities can come to seek out opportunities in the pre-IPO market.
Okay. And what was the inspiration of starting Hive? I mean, that's always the fundamental question, right? Because you have faced issues with the liquidity, with the transactions, and how it's done.
Mm-hmm. Yeah. So what the inspiration for starting Hive was sort of really twofold. I think that in the 20 teens, so, I guess secondary market trading in private securities first, or I should say venture-backed companies, really first started with Facebook and Twitter in terms of an actively traded market back in, I guess, around 2013 or so. And, at that time, it was a pretty new concept to trade private securities. Over the intervening years, the market grew quite quickly, and to the point where it was growing, let's say, 1 to 200% every single year.
Wow.
And then, of course, by the late 20 teens, there was over 1,000 unicorns primarily in the US. The market had obviously grown a lot, but also had become quite chaotic. And so I think what was the features of this market was you had securities, which were obviously commodities to some extent, in the sense that a share of Uber was a share of Uber, similar to the way a barrel of oil is just a barrel of oil and has a quoted price. So or a public stock has a quoted price. And so there was this ability to quote prices for these stocks. And I think that made me realize that the market would benefit from some degree of centralization and automation. You had a bunch of brokers who were sort of chaotically running around the market in a very disjointed and fragmented way with no oversight or controls from the issuers and not using technology at all when it seemed to me that this type of transaction process was highly amenable to a technology solution. So that's why we pursued Hive, was to, on the one hand, centralize the market, but also offer private companies a way to automate and control the secondary process, offer liquidity to their shareholders on their own terms.
Okay. And Hive is focused, as you mentioned earlier, on the company secondaries, right? The market of secondaries overall is much broader. So it includes GP secondaries, LP secondaries, and you would be the perfect person to kind of paint this picture and explain to the audience what really those GP secondaries, LP secondaries are and how is it different from company secondaries.
That's absolutely right. So so the biggest secondary market, and the one that has existed in private equities going back almost 25 years, is exactly as you point out, Rohit, the market for effectively interests in funds. So not direct investments in companies. And there are two major stakeholders in a private equity fund. Obviously, there's the GP, and then there are the LPs. Now, LP-led secondaries are the trading of investments in funds, and that's an LP secondary market. And then there's a certain category of secondaries around funds called GP-led secondaries. Effectively, the GP is sponsoring the secondary transaction. GP is the manager of the fund, sponsoring a secondary transaction whereby they bring in a new investor to effectively back them to continue to manage the fund, and while still providing liquidity to LPs. So that's sort of the difference between a GP-led secondary and an LP-led secondary in funds. Where company secondaries fit in is that, of course, these are the portfolio companies of the funds, themselves. So the fund holds portfolio companies, and there's a secondary market for shares in those underlying portfolio companies, and that's the focus of Hiive. Although I myself was very active in LP secondaries for many years. That's kind of where I started in the secondary market.
Okay. And can you paint this picture? Because you rightly mentioned, within private equity space specifically, this GP led and LP led had been going for some time, although all those conversations were a bit confidential and never declared because they used to happen at discount to some extent to the NAV, what the going price is. And right now, in the last few years, the market for company secondary has ballooned. It has grown tremendously, and that's where the most of the noise, or let's say most of the news, is being captured these days
Yeah.
by the social media. So how have those three segments grown, and why do you think this company led is the future?
Yeah, I will say that the reason that I guess company secondaries have grown at a very rapid rate is because so there's always a very strong sort of impetus historically for there to be a secondary market for LP stakes in funds, so GP and LP secondaries. There was always a strong impetus for that historically because funds don't have sort of a natural exit for the fund as a whole, right? You have to wait for each individual portfolio company to exit, and then eventually the fund returns all the cash to the investors. But in reality, those funds were not reaching full exit after sort of their regular 10-year life. And so the market for LP secondaries or secondaries of investments in funds naturally arose a long time ago. Now, on the flip side, the concept of sort of very long duration being private didn't really apply as much to venture-backed companies historically. And the reason for that was because either you were a very successful company, you grew to be a very strong commercial business, and then you were either acquired or you went public. Or in the case of most venture-backed companies, most startups, the company failed, right? And that is obviously a natural kind of state of startups. Most startups do fail, and then a few of them obviously succeed quite mightily. And so because those were generally the outcomes for private companies, you didn't see a secondary market for private companies arise earlier, like in the knots, right, in the 2000 to 2010 kind of period. What then happened was you saw an environment of fewer and fewer exits for startups.
Okay.
So even very successful startups, companies valued in the billions, were not able to obtain, an exit such as an IPO or an M&A event. And there are anti-competition rules, competition type rules in the U.S. that have prevented a lot of M&A activity as well. So the exits have been limited for. Meanwhile, a lot of these tech names are sort of what you might call the sort of hype names, right? They're known very well to the individuals out there, individual investors. They're known beyond just the institutional investment community. And so the combination of these two factors is what I think has really given so much momentum to the secondary market for shares in venture-backed companies over the last 10 years or so. Just the fact that they have so much name recognition in the broader world of individual investors, and then just the limited prospects for exits. And the combination of those two factors means that something's got to give. So much demand for these stocks and no way to go public or no way to get an exit. What does that mean? Trading in the private securities. And that's why I think this market has really taken off.
I love the structured answer that you provided. One point that is often coming up is the ramp up for executives or employees who want to maybe sell their shares in the secondary markets. How bigger this chunk of, let's say, sellers, or they're mostly sellers on the sell side, right? Correct me if I'm wrong. Is this ecosystem, and how fast are they growing?
They're growing quite rapidly. So I think historically there have been some stigmas associated with the secondary market, especially for venture-backed companies. There's this idea that you must be loyal to the founder, and since the founders in it got their skin in the game, you need to have skin in the game, and you need to hold on to your shares until there's an exit. Otherwise, you're not loyal, you're not aligned, you're not incentivized. Concept sort of held up reasonably well when the liquidity was available to private companies by means of IPOs and other exits. Now that that avenue is sort of largely closed, the period, and then a lot of private companies, by the way, may have the option to go public, but are electing to remain private, right? They're electing to remain private because they find it more attractive to remain private. They don't want to go through all the rigors of becoming a public company.
Mm-hmm.
And so in that context, you have now employees who have been going on 5, 6, 7, 8, 9, 10 years holding vested securities, vested options in these private companies, and ultimately holding stock because eventually they have to exercise their options and buy the stock, and not having a way to monetize that. And, I think a lot of employees feel that, well, I didn't really sign on to sort of hold on to the stock forever. I expected that, after a 4-year vesting period, that I would own the stock and I would be, and ownership certainly has a implication that you can sell, right? What's the point of owning a financial asset if you can't sell it? And so I think that is that there's sort of a dam there that's kind of now has a lot of cracks in it, has become like a leaky dam, and probably is on the verge of breaking because there's just such a need for liquidity. And interestingly, I'll just add, and so to answer your question, the number of executive sellers, employee sellers, all that kind of stuff has just exploded over the last few years. We ourselves are doing about 200 million per month in transaction volume. And I think that market's continue to grow. But one of the things I'll just add is that it turns out that conventional wisdom that, you maximize alignment, loyalty, and so on by stopping employees from selling, it turns out that that's actually not true. We've done some studies through surveys of employees, blind studies, where we didn't tell the employees the reason why we were asking the questions, and we just basically mapped their answers to whether they were at a company that was restrictive or whether the company was permissive of transfer. And it turns out the employees of companies that allow them to sell private stock had higher responses for employer brand basically across the board. So they rated their employers as a better place to work, more likely to recommend to others, more likely to remain, even though they had the opportunity to sell their stock and therefore they didn't have skin in the game anymore. They were actually more likely to remain with that employer. So it's interesting.
Super interesting. Platforms like Hiive, so implementing technology in the financial markets and specifically secondaries market is growing, right? Secondary markets itself has been catered by brokers, as you mentioned earlier. Now the tech platforms are coming. Where do you see this ecosystem going with respect to managing liquidity, implementation of tools, and so on?
I think there's two trends. First of all, on the sort of the technology side or the service side for private companies, it's very important that we continue to build a very comprehensive solution that meets the needs of companies, right? At the end of the day, the issuer itself, the company, is the most important stakeholder in this process. The issuer needs to have tools that enable them to do things like tracking all of past pending transactions, understanding or executing the transactions. So being able to automate that process, because right now the execution process for companies is such a burden. They've got to be involved in signing purchase agreements and exercising stock options and sending wires and all these things, adoption agreements of various kinds, opinion letters, and so on. So there's a lot of these little pieces of the process that are really burdensome for companies. And we're able to automate that process and make that very straightforward for them to complete. So I think that's an important piece for the companies. And then obviously, then they start to tap the platform for other purposes, such as ongoing tracking, or possibly even raising primary capital using the same liquidity pool that exists on the platform. On the market side, I think it's very important to continue to consolidate the market, right? There's a lot of inefficiency in the market by virtue of the fact that there are different hubs of trading. Because this is an illiquid asset, it's almost more important than in any other market that we consolidate trading in one place, because that's going to lead to the overall maximum outcome, I think, for all parties. So for that reason, Hiive is really focused on building relationships with external brokers, for example. So we deal a lot with external brokers, third-party brokers. We're very friendly to them. We offer them generous terms on things like fee sharing and all that stuff in order to really bring as many brokers and as much activity to one place as possible. And so I think eventually Hiive evolves into more of an infrastructure for the market, and then with brokers participating in the market, as well as customers, investors, and customers participating directly.
Okay, so within the ecosystem, next 2 years, 3 years, maybe 5 years down the line, you see an involvement of the brokers as well as tech platforms, and they can co-survive, they can co-live, right?
Yeah, I think brokers will. I don't think brokers will go away. I think what will happen is they will start to participate as important players on the platforms. So, and the platforms will increasingly evolve into infrastructure. So, interestingly, if you think about the history of the exchanges, from what I understand, started off essentially as brokers or market makers themselves, and then over time they ceded the territory of market making and brokerage to brokers, and they became just the rails, right? They became just the exchange, the infrastructure for transactions. And I think we may increasingly see that evolve. Now, of course, on Hive, buyers and sellers can access the market directly as well. So, both options are available.
Okay. And you captured some parts or a lot of parts of the next question that I want to ask, but still, if you want to focus on additional pointers, please do that. So what about the efficiency of the market? There's always this discussion of how efficient is the market, how efficient are the transactions, and so on. From the perspective of a seller, let's say an employee who is coming on the platform and trying to sell, and also from the perspective of a buyer. So, do you think we are now at a position where we can say the secondaries market for company secondaries is like efficient, or do you still say we have some length to go there? And if there is some gap, where are those gaps?
Yeah, I think that it's too early to say that this is an efficient market. I think that you have one of the issues is that right now a lot of buyers will participate on multiple platforms, and some of the more savvy sellers will also do that, right? I mean, sellers are more occasional than buyers in this market, and therefore they're less sophisticated sometimes, as well as less likely to be really shopping around a lot, because it's really like a one-time thing for them. They don't need to invest in understanding what's the best possible solution out there. They just want a solution.
Mhm.
Now, so I think back to my point about market consolidation, I think before you're going to see right now you've got fragmented pools of liquidity. You don't have one major central pool of liquidity. I think you'll see more efficiency in the market once there is sort of a more centralized pool of liquidity, and more of the market activity consolidates in one place. And then I think on the technology side, there continues to be lots of opportunity for further efficiency in the transaction process, in things like transfer process. We've technologized a very big part of it,
Okay.
but there's a lot more work to be done there in terms of really making things truly fully automating the process.
And if I may ask, are there funds which are specifically targeting these company secondaries? Or are there VCs who are using this opportunity on platforms like Hive to grab additional stock of, let's say, companies they probably want to grab onto, right? So, how's the dynamics on the fund side?
Yeah, so due to the regulatory nature of a VC fund, because of the way VC funds are set up conventionally, they actually have very limited ability to trade in the secondary market. I think they can invest up to 20% of their portfolio in secondaries.
Okay.
But I think that the players or the structure, the investment structure that's more flexible is the registered investment advisor. And most commonly, you'd think of, like, for example, a hedge fund would be in that category. But a lot of the dedicated secondaries, so there are many dedicated secondaries funds to your question, and those funds are typically set up as RIAs. You also have RIAs who are acting as advisors to, for example, wealth clients and so on. And they have that flexibility to transact quite actively in the secondary market. So it's mainly of those players, secondary funds, crossover funds of various kinds, hedge funds, and other more dynamic players, often who are structured as RIAs, who can act on the institutional side, who can really participate there. And then VCs, we're actually seeing a number of some large VCs have actually started to convert into RIAs, and we're seeing them become more active as a result in the secondary market.
Okay, interesting. Let's move on to the investing dynamics and what's really going on those individual, let's say, transactions. So we already kind of established that the market is not super efficient. One of those outcome is there's a gap in the bid versus ask. There's a spread, right? Talk us through this bid ask spread, which you see on Hive platforms, and if there are some trends that you see already, which companies tend to have, let's say, narrower spreads, which probably
Yeah. So there are certain securities on our platform that trade extremely actively. And when those companies are more liquid that way,
Mhm.
you start to see a more narrowing of the bid ask spread, right? Because once there's effectively a more regular cadence of transactions crossing,
Mhm.
what that means is that market price becomes more established. There's less of a sort of an expectation or realistic expectation that you could price away from that band, right? And it's only when someone's pricing as a bidder or a buyer or seller
Okay.
away from an established price band that you see a bid ask spread emerge. So the greater the liquidity for an individual stock, the less of a bid ask spread you will see.
True.
Some companies that have less established markets will have wider spreads.
Okay. And if you can paint a picture on, for example, you see narrower spread with respect to 20%, 30% of the market and the remaining larger spreads. And how do you see those spread converging or diverging recently, let's say 2025?
Yeah. So you definitely see the narrower spreads for I think it's more than 20 companies. Like right now, so we have an index called the Hive 50, which is
Okay.
the 50 most active securities on Hive. And I think most of the Hive 50 companies, and you can see the index members, they're listed on our website. For most of those companies, you're going to see a pretty narrow spread. The percent spread is a tough one to sort of really look at on an aggregated basis. I don't have the exact numbers on like market wide what that spread is,
Okay.
but for a more liquid security, you may see spreads as low as a few percent, and then for less liquid securities, you may see spreads as high as 20% or more.
Okay.
And then some securities that are totally illiquid, the concept of spread doesn't really even matter anymore because there's
Hmm.
not really any orders for a lot of stocks as well.
Okay.
But we've actually had since our inception, there's a perception that there's a few only a few companies that are trading. I think that that's a function of the fact that the market's very illiquid and fragmented right now. So
Hmm.
most of the liquidity pools are quite small. And when you have a smaller liquidity pool, by that I mean like let's say a local broker or a small marketplace, small platform, you're going to only see activity in the most liquid securities, and that may be as little as 10, 15, 20 companies. On Hive, we've actually since our inception had direct shares trades in over closed transactions in over 300 companies
Okay.
since our
Wow.
inception. In any given quarter, we probably have transactions in as many as 50 plus companies.
Okay. And with respect to the premiums, do you see premiums as well, or are most of them at a discount?
Oh, you most certainly see premiums. I mean, look, in bullish times for the market, like when the market's in a bull run in general, you'll often see most of the hottest names trading actually at big premiums to their last round valuation. This is not a surprising phenomenon, right? Because when a company's growing and its performance is rising, you should expect to see valuations rising as well. And so the fact that company raised 6 months ago or 9 months ago at a certain price is really of no moment, in the sense that the expectation is that if it's grown since that time, 6 or 9 months ago, then it would be trading at a higher valuation than it did then. Let's say if it's growing more than expectations or in line with expectations. So yeah, you will see sort of a lot of trading today in a little bit of a slower market today. It continues to be a tougher market since 2022. You'll see fewer companies trading at premiums, but you still see a lot of companies like the AI companies, crypto
Yeah.
companies, that this type of
Yeah.
stuff, the ones that are pretty hot, right? Areas that are quite hot right now, you'll see a lot of companies trading at premiums.
Okay. And I saw like within your report on the private markets for 2025, the
Mhm.
specific line trading data indicates that marketplace dynamics are shifting in favor of sellers. Can you expand on this? Would it mean that the sellers are less in number and they kind of control how the dynamics are with respect to pricing and so on?
Yeah. So generally speaking, when in an illiquid market like this, when the market is stronger, you see more buyers and fewer sellers, and
Hmm.
that's what leads to rising pricing, right? Because more buyers are chasing fewer sellers, which results in buyers bidding higher and higher in order to obtain
Hmm.
that supply. This was a phenomenon that we very much observed in the first, let's say, 3 quarters of 2025. Throughout most of 2024, we saw a tilt towards a more of a seller's market. This is a function of obviously the public markets rising quite rapidly. And now, this dynamic has kind of actually changed again and started to reverse again. So I don't have the numbers in front of me right now, but I think the evidence suggests that the market is shifting back towards buyers recently. I mean, that's not a big surprise. Everyone knows that the public markets have been suffering of late, and things have definitely cooled down in sort of like the hype sectors and tech sectors and whatnot. So yeah, now you're seeing sort of, I think, momentum shift back towards buyers more recently.
Okay. And with respect to setup, obviously you explained it beautifully how there are some stocks which have more liquidity, a narrower bid-ask spread, and so on. From the market structure perspective, do you think a few years down the line you see this improving, or do you still see that within secondaries market, specifically for company secondaries, the situation will persist? There'll be like few companies on premium, narrow bid-ask spread, and so on, and the rest of the others will have liquidity.
I think the market's going to continue to broaden out. If you had asked me that, 5 years ago, if there would be, 50 companies actively transacting every quarter in the private market on one platform, I would have said no way. Or that, we would have closed transactions in 300 different companies within 2 years of launching, I would have said, wow, like no chance. So I think we're definitely seeing an increase in breadth in the market. The market continues to be dominated by 20 to 30 names, but there's definitely activity in a much wider range of names. Whether or not companies are going to trade at premiums or whether or not they're going to be bid-ask spreads is going to be a function of really two things. One is the market in general. So is the market rising? And generally speaking, if a market is strong, you should see premium pricing for a lot of stuff, and you should see narrow or no bid-ask spread. The second variable will be whether or not that individual company at an individual security level has liquidity. That'll be a function of other factors. So it'll be obviously interest in that company, but also it'll be a function of whether the company itself or the issuer itself is facilitating liquidity, right? They need to be allowing shareholders to trade. They need to be, if you stop people from trading, well, it's a self-fulfilling prophecy. You don't like the price of your stock, you stop people from trading, the price is only going to get worse, right? Because people assume that you can't buy or sell. It's illiquid. Because it's illiquid, they don't want it. Investors don't want to get into something that they can't sell. So limiting liquidity can be a kind of a downward spiral, right? It can result in even worse market outcomes, which then makes you want to limit liquidity even more because you don't want to be printing trades at lower prices. And now, on the flip side, if the company allows trading, if they can do things like, for example, we're working on model information disclosures for private companies. In other words, preparing a very high level report for the market. It could be as limited as one page. It would be sort of, let's say, a tiny fraction of what public companies disclose, and only high level metrics that wouldn't have high level market sensitivity. Like, for example, if your revenues grew 50% last year, there's nothing that's really sensitive from a competitive standpoint about that information, right? I mean, I'm happy for my competitors and everyone else to know that I'm growing rapidly, and it doesn't tell them how I succeeded at doing it, right? It doesn't tell them anything about my secret sauce. So we're encouraging companies to provide high-level KPIs, revenues, and other types of metrics that buyers can use to understand value without necessarily, dropping their shorts and sharing everything about their company with the world. And if they take those types of steps, they can facilitate liquidity, reduce bid-ask spreads, possibly attract premium valuations, and so on.
It's amazing what you're doing because it adds on to the transparency of the market as well, right? And more the transparency, I think it's much better for the secondaries market overall.
Absolutely. Yeah. That's and transparency has sort of many themes in the secondaries market. And one of them is obviously just price discovery and having a central place to go and see what the price is. And that was one of the visions. We always dreamt of having like rational price charts for private companies and having enough liquidity to show a natural price chart. And I think that what you talk about in terms of transparency around at least high level transparency or reasonable transparency around company performance and all that kind of stuff is the sort of the next chapter here.
Amazing to hear, because it then brings depth to the buyers as well. For example,
Mhm.
right now the buyers may be within the VC ecosystem. They might be knowing the companies very well. However, if you have more transparency, more data, and as you mentioned, all those factors on your website, it inspires other investors to participate in this, I would say, sub asset class, right? Secondaries is not a complete asset class in itself, but sub asset class. So you mentioned about broadening of the securities in terms of how their bid ask spread could be better and premium and so on. So this is on the individual names perspective. However, I want to kind of zoom out here and think about the time we are in, and secondaries gaining ground in the last couple of years because of the reasons that you mentioned earlier. There were DPI issues with respect to the funds. So there was a hurriedness to, let's say, sell and to get those transactions done. However, let's say 3 years down the line, we don't have a crystal ball, but the economy, the venture economy, the ecosystem improves. What do you think will happen to secondaries? Will the company secondaries, the people, executives, and everybody try to hold on to this on their stock even longer? What do you think will then happen to the liquidity and individual names?
I actually think it will rise. Liquidity will rise in that context, and the reason for that is simple. Again, going back to that market dynamic of buyers bidding higher and chasing sellers, right? In a bullish market, in a liquid market, that's what you see. You see buyers bidding up prices and sellers sort of raising their asks. And so, but it's my observation in the 17 years I've been in private markets. What you see is that in good times, because prices are rising, more sellers are accepting those offers because they're saying, well, look, I might as well sell something. I don't know what's going to happen tomorrow. Price is rising. Seems like a good time to sell. So what you see is it's in the boom times when you see the high degree of activity, even in the secondary market. And ironically, it's in the downtimes when you see limited activity. And it's because, again, it's a reverse phenomenon where sellers want yesterday's price, buyers want tomorrow's price. And that's what leads to that bid ask spread, which is that, because of the illiquidity of the market, prices can't correct overnight. And it's going to be a function of what are buyers and sellers bidding. And so actually, I think when the IPO window opens up, that would actually be a real boon for the secondary market, because that would mean that you'd have a lot more buyers seeking exposure on a pre-IPO basis
True.
so that they could get in early,
Yeah.
and a lot of sellers accepting those, higher prices.
Awesome. With this, thank you so much for joining in and sharing so many insightful nuggets on the secondaries market. All the best for you for the Hive platform and its growth. Thank you so much.
Thank you, Rohit. I appreciate you having me on.